do. Yeah, your internet is a little bit fuzzy. Yeah.
It might be when I'm like loading a page.
Okay.
Have you? Cool.
Okay, so yeah, hey, we're live, guys. This is Justin from EOS Blocksmith with us, and we're doing our weekly tokenomics and DACs webcast. So glad you could join us. There aren't there isn't anyone else live here with us, but hopefully people will start dropping in a little bit later in the session. Yeah, this is I always look forward to chatting about DACs and tokenomics. So this is always, this is really one of the main topics I'm interested in right now. So and Justin as well. So I'm glad he's here, and occasionally we'll have other people who are interested in join us for conversations. We'll do interviews, and Justin just mentioned, hey, Shaheen, how's it going? So he's Shaheen with EOS Blocksmith as well. And if you want to join us in our video chat, let me know. I mean, I can invite you in. This is very informal, unstructured. If we do have interviews, we will have a little bit more structure. Okay, yeah, Shaheen, yeah, if you could put it in the calendar, that'd be great. Hopefully we can kind of get some more people in here. But yeah, anybody else who wants to be in the video chat, just let us know, and we can invite you. Otherwise, so Justin, you were mentioning maybe as an idea to invite the EVA guys, and I think they're from France. We had them on EOS Ignite. And maybe you can explain, Justin, a little bit about them and what your thoughts are about that.
Yeah, sure. Well, yeah, I'm kind of interested in what they're doing. They're making sort of a decentralized Uber system where I assume the drivers get a stake every time they actually take a rider. And I think it would be really awesome to see the benefits of that and see also how they're running their tokenomics model. I've actually got a video that's from EOS New York. EOS New York was talking to Eva during the Blockchain Live conference, and Eva did a bit of a quick run through of how it worked. I was wondering, Jun, do you want to maybe share your screen and we could maybe watch that and show everyone?
Let me do that. Let me see how we can do this. Well, let me put my speaker kind of next to my microphone, and what I can do is I can screen share here. I'll just screen share my okay, so this is this is the video, right? So
yeah, that's it.
So let me just share it right now and see how it goes.
EVA is ride sharing on the blockchain. It's very similar to Uber, except because we run on the blockchain, we can offer a much lower fare to the rider and a much larger share to the driver. It works on iOS and Android, very much like Uber. The user can search for their destination, select it, and the fare is presented in their local currency. They pay in credit card directly integrated with Apple Pay or Google Store as an in-app purchase. We issue them tokens. They issue those tokens to the driver at the end of the ride, and at the end of the week, the driver returns those tokens to us, and we exchange it for fiat so they can pay their bills.
Interesting.
So yeah, that's great. That's great. I like the kind of the quick demo they had, and I think this is great. This is fantastic. Decentralized Uber and Airbnb are I think applications that are very ripe for disrupting, and this is one of the ways to do it. So yeah, I mean, any follow on, Justin?
Yeah, I think firstly, I think Shah said he'll pop in for a minute. I don't know if he's referring to today.
I'll invite him.
Maybe get him in. But yeah, I'm kind of curious because it sounds like the drivers earn money in kind of the fluctuating token, and then they're sort of forced to stake the token for a week in a way because they can't actually convert it into fiat until the end of the week, by the sounds of it. So they don't have access to sell it until like a full week is up.
Okay. So yeah, that's interesting. You had to keep it for a week, which is okay. I mean, I think Steam is the same way, where you write a post and you have to wait a week before you get the rewards. So as long as it's not too long, like a month, a week is probably just.
It's not too bad. I guess the problem is though, like depending on the volatility of this new currency, you know, it could half by the end of the week, and then you don't have money to pay your bills. But I guess that's the risk of a system like this. And I guess in theory, perhaps it is something that will have an increasing demand. So the expectation is that the token will actually go up in value anyway, so it's not a big deal.
Yeah, and that's the hope. And then I think again, I might have mentioned last week, or I've been talking about how stable coins I think are more appropriate for all the platforms, just in terms of usability and people don't pay in stocks, right? They don't pay in like whatever stocks that they own, and that to me is what a lot of these tokens represent. I know SEC wise, maybe a lot of people don't want to associate these tokens with that, but the volatility is natural, just as a business company has greater ups and downs and risks and uncertainties, and you have a natural volatility. So I always say, well, you can always use your tokens and just number one, display it in dollars or euros or whatever your local currency is. But ultimately, I do think that there should be a stable coin also built in the system that allows you to make transfers back and forth so that you can manage your risk, because everyone's got a different risk profile.
Definitely.
And allowing people to manage that is important. Everyone's got different risk tolerances. Everyone, people like I was in financial planning, for many years. And so if you're young, you're fine with having, higher percentage of stocks. If you're old, you're all about income and dividends and just conserving your wealth. So everyone's situation is different. Same thing in just even if you're in the same age bracket. Some people have more risk tolerance. Some people have maybe more cash, so they're not as worried. So everyone's situation is different. So regardless, it could be that your age, it could be just your situation. So that the ability to be able to manage your own risk and your allocate it based on your risk tolerance, I think is important. So that's what a stable coin allows. And then there's another conversation about, what is crypto? Is it a money as kind of store of value? Or to me, it's more like security, unless it's more commodity like. I mean, EOS and coins like the core token can eventually be that. I say Bitcoin probably has a slightly better chance because it's just really like a commodity type asset, and so it may have lower volatility and whatnot. And so gold is another example that is, I think, more stable. So those are the things I think we should consider in the tokenomics of a system. So I'm very much leaning towards stable coins as being the at least in the short run, the token of choice for the utility aspect of a system. And and I'm fully okay with the idea that it's more security, like the token. I'm okay with that. What are your thoughts? Because I think people hesitate just because they try to make it more like a utility just for regulatory purposes. And
true.
But what do you think? Like fundamentally, are people expecting? Is there an expectation of profits, right, from this token? And I could say you could design it where there might not be. It's more like a utility, but I just think a big component is the security aspect of it, and that's, to me, if we can build a DAC that's resilient to the actual SEC enforcement of that, that's a way to still use kind of securities and just call it security on the blockchain. But I do think it's riskier. It's kind of on the edge if you go that route. But what are your thoughts on that? I mean, I'm just openly discussing this as a sorry about that.
No, those are very good points. I think technically it's a utility because when the purchaser of the ride sharing, when they purchase in fiat, it turns into kind of the EVA token, which gives you a certain amount of ride sharing. But the problem is it's like a fluctuating utility. It's not like if you go buy a phone credit, you know that, if you buy $10 worth of phone credit, it gets you X amount of phone calls. Or if you buy AWS credits, they give you, what you're getting basically. Basically, these sorts of utility tokens, depending on the supply and demand of the system, like as the demand increases, you actually get more for each utility unit, if that makes sense. So it's sort of like a security in a way, because if you have it, it's going to increase in value as long as the demand increases. So it's like a new category of its own, really, that I suppose the SEC can't maybe put a firm plan on exactly what it is. It doesn't necessarily give you interest return or ownership in the system, but it does give you an ownership of utility on the system, which in this case is ride sharing.
Okay, so so now I agree with you. If that's the design, you can create the utility token type system, which you describe, and I think that's what EVA is doing. So maybe the one thing I was discussing was just more of the traditional kind of equity system that a lot of people are trying to avoid. So, but you can design it such that, as you describe, the utility is the token represents the utility, but like you say, over time, you can gain more utility over time. So, but the difficulty in that is, I think we're separating the investment side and the utility. And if you incorporate it into the utility side, it's for usability reasons, it's a disadvantage, because you want the utility to be, you want to be able to understand like what the utility is. And if it is volatile, then it's the same thing as if you use a currency that's volatile, right? You don't know what you have, right, on the utility side. So that's why I say it's better to just kind of, give that up and just say, I'm going to just use a stable token that people understand is broadly understood as a unit of account, and just separate the concern, separate the investment side, separate the utility side as just cash compensation that's stable, that doesn't change. Maybe you can increase or decrease prices slightly, but is not really tied to the the token value, which is based on a network effect and other factors that is hard to make judgments on.
Definitely.
So that,
it looks like, so from the rider side, it looks like the rider is paying with their credit card, so it's stable for them. They know it's going to be $30 for a ride.
Gotcha.
But then you're right, on the other side for the driver, it is going to fluctuate, and that, like, maybe they can build in some speculation into the system where speculators can hedge on if it's going to go up or down, and then that can produce a stable token within the system, and drivers maybe can select to be paid in a stable token instead of this fluctuating utility token. So that would be an interesting concept. But the other thing is, like, in our future world, like, you might not necessarily be working on a single DAC or DApp. You might be doing being a driver on Eva one day, and then you might also be doing stuff on Steam or another social network. You might do all sorts of different jobs, and within those DApp communities, they might be more stable. Some might be more stable than others. Some might be newer or fresher and have high volatility, and others will be more predictable. So if, as a person, you get used to the idea of having that risk of fluctuating utility values, you can hedge your bets by being involved in a number of different communities, as opposed to how we work now, in that you basically usually do 40 hours at one job and maybe nothing at all.
Yeah, I agree with you there. I think, and then the other, so everything that you say, I agree with you. Also, I think you're legally safer if you create it in such a manner that it provides a utility. So I do think legally that's actually a safer way to construct the tokenomics. But to me, I feel like, again, if it's being afraid of the regulatory aspect, but if it's more usable or it makes more sense to split that, I just think that might be a better approach. But if that means legally you're more vulnerable, which I do agree, if you go that route, you kind of have to deal with, I think, greater regulatory scrutiny. So I do think, I think you'll probably be much safer if you go the utility route, and I do think you can make that case, and I think you could win against the SEC if they go after you. The way I'm looking at it, I think, is riskier, but I feel like it's more just more logical, right? So I want to even go beyond, even with the greater regulatory vulnerability. I feel like it just makes more sense, and I just want to create a pure security on the blockchain. That could be right. That's where I'm leaning towards. I'm like, let's go that route and explore that and see what kind of enforcement mechanisms that
we should explore both routes, because like you say, it's unproven whether you can do this utility and people will accept all the volatility. And we've already got a proven method in using securities and stable tokens. So I don't know. We just have to find out. It's worth exploring. Hey, Shah.
Hey,
how's it going, Shaheen?
Good.
So he's Shaheen with Blocksmith. Is great to have you. And we got a lot of activities in the San Francisco area coming up. So hopefully you guys, if you guys are interested in participating in the hackathon, and Shaheen and Rahman are organizing a conference right after the hackathon. So be a lot of good activities. But just anyways. So yeah, what do you think, Shaheen, about this whole tokenomics? So Justin is suggesting the utility token side, which makes sense, and I think it's safer against regulation. I think you have a strong case against the SEC. I'm on the edge of going right against the SEC and saying, hey, I'm like, just do the stable token.
I'm not necessarily for one or the other. I'm just for exploring all the options. Like, that's the beauty of this we just like have a new economic world where you can just explore things and find out, does this work or is it an absolute flop? You know, so I'm looking forward to figuring it out.
Yeah, and Jake right here is an EVA advisor. So yeah, if you have questions, if we have questions about just anything going on with EVA, we should definitely.
Can we get Jake on as well?
Yeah, I can pop off because Jake's probably
no.
We can get more.
No, feel free. We could actually get 4 people here. So, but
oh, exciting.
So yeah,
we were just talking. Well, so Ramon and I were talking about this because for the scaling blockchain conference that we're going to do after the SF hackathon, Ramon was like, it'd be awesome if we could have like a little snack bar area where people can just pay EOS and buy snacks. And I was like, whoa, dude, that sounds like all kinds of issues.
Yes.
And so he was very he's like, no, I think it'll work. And so we've been kind of like trying to work that idea and get it past the legal team for the
yeah, it's so funny because something as innocent as like selling snacks for EOS is like things you have to think about. Even airdrops are things you have to think about, which is like, hey, I'm just giving away tokens, but
exactly,
the lawyers will come and say, hey, you got to be careful about everything.
Exactly.
So
yeah, there was so I was right now there's blockchain week going on in San Francisco, so it's pretty exciting. And I think Vitalik is here, and there's a lot of other big names. And I went yesterday because I was off of work, and the most interesting panel that I went to was one that was discussing securities and tokenized securities, and that one got heated. People were like, okay, it was so interesting though, because it is like one of those topics, where people get pretty passionate about what their predictions are as far as regulations and how blockchain is really going to end up, at the end of the day, right? It's the technology. So one of the biggest things was it's not the technology that's holding us back at this point, right? Because I think, we've seen that blockchain can kind of, make tokenized securities work, right? It's the regulatory, that's the friction, right? We've got the technology, people think it's going to go there, and the question is why aren't we there yet? And it's the friction of the regulatory environment and the uncertainty.
Yeah, it is. So,
but yeah. No, one of the most interesting things that one of the people on the panel was talking about was so the first question was hey, let's define a security, right? And it was actually a good question because the panelists had differing views about that to some degree too. And one of the best explanations was one of the people had worked on Wall Street as a junior trader, and so she remembers a lot of this. But she's like, this is securities have been around for hundreds of years in the forms of these paper bonds, stocks and bonds, and it got me, I'm thinking of Die Hard, when Hans is trying to break into the safe and steal all these securities in the form of pieces of paper, right? And that's what securities were.
Sure.
And now we look at securities as these digital, she was kind of describing how there's just one central digital repository that manages this stuff, and people are trying to say blockchain is going to replace that and just make digital versions, go back to those paper bonds, but a digital version of that, right? So that it doesn't have to be one central database. And then the question came up. Sorry, I'm just throwing out a lot of ideas because it was such a fascinating panel.
That's so true.
But then the question came up was okay, if that's what we're doing now, right? If that's the goal, is to take these paper bonds and stocks and turn them into digital versions of these paper bonds and stocks, right? Then what do we do if something gets stolen? One of those tokens that gets stolen, right? Do we treat it as the old paper bonds and stocks, right? Where if criminals somehow figure out a way to steal that, then it's theirs, it's their value, right?
Yeah, there's no protections.
Yeah, if you treat it that way, fine. But if you don't want to treat it that way, then you need some kind of governance think, because it's not the same as a paper bond, you know, or a paper stock.
Hey.
So yeah, I just brought Jake in here, but yeah, that is a fascinating. You know what, you identified, and I think the panel identified, at least on the security token side, one of the problems of security tokens, because you have two different systems. You have cryptocurrency that are more like bearer tokens, and then you have securities that have it's kind of like a title, a separate property system. You got a title to a security, and so how do you make those? How do you integrate the two? Right, they're kind of two separate systems, and I think there is a problem. There's a legal issue with that. You almost can't kind of have it in this wild kind of crypto economy, because there's different property rights when those get passed around, versus a security that has a specific, I guess, regulatory, like a regulatory framework and a property system that's based on, securities law, companies, like based on company securities that are created when you form a company. So there is a big challenge. I think that, I'm not sure, that's the biggest challenge for security tokens. If anyone talks about security tokens, they have to resolve that issue. If they don't resolve that issue, it's going to be stuck. And that's why I am a little lukewarm about security tokens, just precisely for what you mentioned, Shaheen. Everything else makes sense. I mean, if we can securitize freely all these kinds of assets, I think we're great. We're fine. And if you start from purely a blockchain world, I think it's okay too. But it's when you actually have an existing security in kind of the traditional world, and then you try to somehow create a token on top of that, I think that's where the problem is. So to me, I say, hey, start crypto. If you have no like current security, you might be able to do it purely on the blockchain and somehow make it work. But it's actually more difficult if you have an existing security with, based on whatever jurisdiction, whatever state that it's formed in, your company is formed in, and the securities are issued in. That's problematic, I think. But anyways, so go ahead. Any other interesting things on the? Hey Jake,
what's up, Jake?
Yeah. Hey guys. No, this whole security thing is very interesting. I was talking with my friend yesterday about it. I can't go into too much detail, but we went to, yeah. He might be watching. No, I'm joking. He's a really cool guy, but once we get that sorted out, I'd definitely love to come back on and show you what we're thinking about. But with Warbly, I did a interview with them, and I find it very, very promising what they're doing and how we can implement not only securities on the blockchain, but business logic itself. So how we can run the business can be completely on the blockchain, and how we can, put our own ledgers there and be able to interact, and people can send money to our account and do everything kind of like how a DAC is doing. But, of course, it's just, it's shared among the shareholders.
Yeah, that's an exciting part of it. I mean, we could do all the traditional business organization purely on the blockchain, and Justin and I were in kind of previous chats we're talking about that. I think that's the future, really. To me, one of the greatest benefits is this organizational feature, like the way we can build and create new organizations that don't rely on our current methods in whatever state jurisdiction or whatever country.
I'm really hoping for Liberland to fork EOS IO, and then we can just automatically get business licenses through them and just have our whole business live on their blockchain and be completely legal.
So if you could, I know a little bit of Liberland because I heard of it. I think it's, but anyways, if you could
I'll give an explanation.
If you could give an explanation, it'd be great.
Yeah, Liberland is it's the world's newest micronation, formed out of no man's land in the middle of Europe, that no one realized was no man's land until this libertarian anarchist, Vidya Litska, decided to start his own country there. And so on the border of Croatia and Serbia, there's a 7 square kilometer piece of land, the biggest one. And that's where Vid decided to start his own country. So under international law, formed by the United Nations, that Serbia and Croatia both agreed to, if no country actually claims a piece of land, then someone else can start a country there. And it's really interesting how they're forming case law around the fact that they can and they are creating their own country, even though they can't go onto the land. Well, I mean, they can go onto the land, but the Croatians will go across the border, illegally kidnap them, and extradite them back to their country, which their own courts have ruled illegal, and told the government itself from the judiciary, saying that you need to determine whether this is our piece of land or not, or you just need to let these people go and start their own country.
Okay, okay, no, that's fantastic. I support the whole effort. It does seem a little bit precarious with the idea that they can kidnap people back and forth. So I'm not sure, especially when I hear Serbia and Croatia. Do I trust being neighbors? But no, I do support it, and it seems as though they're making legal cases, and they may end up being hopefully successful with the.
Yeah, they have backing from Roger Ver and a whole bunch of other people. So I feel like they have money, and they'll eventually. I feel like their plan is to eventually do like some sort of token sale, and that will definitely propel their future a lot forward, a lot quicker than how it has been going for the last 3 years. But it's definitely been going.
Yeah, that's great. I fully support them, and yeah, that's great that Roger's doing that and supporting that. And so hopefully, we'll keep. I'll definitely keep my eye on the project there and support it anyway.
You got something you want to say, Justin?
Yeah, I love the idea. I think it's amazing. I just wonder, why are they picking this contentious land when they could just buy an island and do the same thing, perhaps?
Well, Roger is trying to do that as well. So,
okay.
Yeah. When millionaires buying their own country. I mean, it's just so cool.
I'll move there. It sounds great.
Yeah.
No, it does. I feel like there's certain places in the world, so it's like it needs to be around the Americas. There's different places where you can actually buy land from countries like Honduras and Guatemala, and start your own free private city, maybe like in Haiti, and then Japan in that area. And I feel like maybe somewhere else in Asia, but I feel like those are the most promising areas right now for a project like that.
Definitely.
Yeah, that's great to hear. So yeah, hopefully all of these efforts are kind of gain traction. And and then the other thing I would mention is we can also try to rely on the virtual world as our playground rather than physical spaces. And someone who actually did a good presentation on this. Who's the guy from Big One? Eric Metzelberg, or but he was talking about this idea, the sovereign wealth fund, where you have power by amassing kind of wealth, right, crypto wealth, and that can influence everywhere. So you don't have like a physical jurisdiction; you just have massive power, like this idea of the sovereign wealth fund. That, and he gave analogies of like some other organizations that have this kind of web of power, and so
I would say, sorry to interrupt. I mean, I think the analogy is like these games like World of Warcraft or whatever, where people have like online, personas, and they have like power or whatever. You know what I mean? I don't play it, but I mean, I think we're moving into that realm, right? Like with cryptocurrencies, where the amount of crypto assets and resources you have actually has, more implications in this digital world, in this kind of virtual world that you're talking about, that we're spending more of our lives in.
Yeah, yeah, and it could translate to really. I mean, crypto is like real value now.
It is.
So
It is.
it affects, like, you influence everywhere around the world. This is like real. so
The lines are getting blurred between that like virtual. You know, it's funny because I've been in crypto for a couple of years now, and I've always I've always kind of thought of like, okay, this is like my crypto assets, and then this is like my real world assets, right? Like my funny money or my play money, you know. And sometimes like it fluctuates so much that I'm like, oh, I don't think that's real, you know. That's not real. This is like real money, and that's like my virtual play money, right? Like but they're merging, they're blurring, the lines are blurring, right? And as these on ramps and off ramps for fiat to crypto kind of become easier, and the regulatory environment becomes a little bit more sorted out, it's like these worlds are converging more.
Yeah, absolutely. And I think eventually people are like, yeah, it's just going to be all crypto, right? It's like you can live like purely on crypto, and that you know, it's a very empowering feeling to not have to rely on like the existing power structure, banks and things like that, and be self-sufficient that way. So yeah, it's
something. Oh, sorry, I was just going to say something Shah said just hit something inside me. You're talking about how much tokens or digital money you have is how much power you have, how much labor. Like Elon Musk always says, like money, it's like just units of labor allocation. Basically, that's what it is. It's like how much labor you can allocate. So that gives you power. So it's funny that like in our current system, you know, we have this fiat currency that's issued by a central authority, and it's so kind of arbitrary compared to what is a utility token, like say with EVA or any of these other systems where you are literally buying labor allocation units. So we're actually cutting out sort of a lot of fuzziness and getting straight to the point where tokens are actually labor allocation. Like that's literally what they are.
Okay.
And I just thought that was kind of...
I do think that's I think that makes sense. But sorry, so yeah, that's a great way to think about money as labor units. And
yeah.
So this goes back to like the tokenomics maybe discussion. Maybe we can kind of go back to that discussion. So yeah, money is a representation of labor, or you know, a store of kind of future labor that you know someone has earned. So how does that play into tokens? I think that's largely true with tokens, but you also have this component of in my mind, like a business kind of also, right? And as a business gains traction, as if you were buying like shares in a company, that's also embedded in the kind of utility token. So I would say that there's two components in most modern or most current token models. You have like a equity piece and you have a labor piece. And as the application becomes more popular, the equity piece actually, or the company share piece actually grows more quickly than the labor unit piece. And so that's why I like to split the two, right? And but maybe, you know, in some respects, if it's distributed maybe in another way, where every user owns, like in a mutual system, if everyone owns their labor kind of mutually amongst everybody, then I say, okay, well, maybe that is just a labor unit that you can kind of trade amongst it. But I think for the most part, we assume competition amongst, you know, all these other. So it's more like the equity component that dominates that allocation for the token value. so that's why I feel like I go back to the traditional systems of just say, okay, hey, it's this equity component that we have to kind of manage and incentivize people with, while separating the labor component, which is just can be a stable coin or gold or whatever you want, but it would be that would represent that. So it just goes back, like that's why I'm pretty like I lean heavily towards this way, because to me there's more clarity there. But
there is,
but maybe I'm trying to be open, because I was this whole new economics thing where tokens represent everything, like represent both the labor, the equity, and maybe some other component that we're not even talking about. I mean, this one token representing it all, maybe it could work. I mean, this is kind of a new paradigm and that people have talked about, but I try to kind of dig in. And then I'm like, you know what? It just makes more sense to, like, our traditional systems have separated those.
But does it make more sense because we're used to it? Like, we're used to having lower risk, lower volatility. We're not used to like being so engaged in the risk of a business anymore, or a community. Unless you're an entrepreneur, like someone like Elon Musk, their wealth fluctuates in terms of stable currency by billions of dollars every day, depending on what he tweets out, right?
Yeah.
So he is like totally used to risk, but also like in a future world where you actually get more of a feeling of stake, whether it's in utility or not, you perhaps have more of a buffer than people traditionally have, where they're just working paycheck to paycheck. They're literally living on the edge of what they earn. In a future world, maybe people have more of a buffer because they do get more of a stake in what they're actually doing, so they can actually handle this risk. So maybe we all just get used to more risk in life. I mean, at the moment, I only earn in crypto, and like I'm dirt poor now while the price is down, but I've actually adjusted to it. Like the first few months of like being hedged to the price of EOS was like so stressful, but now I'm just totally used to it now.
Yeah, and I that's a good point. And I think what it does allow us to do with the system is to allow people to earn more equity earlier on. So I do agree with that we should be sharing the equity, and this is what it allows from the outset, the sharing of this equity early on. Now, I do think there's the distinction between kind of having a system that allows equity to be shared versus making the distinction between equity and utility tokens, right? So I say you could do, just as an example, like you Justin gave a link, which you guys should check out, is that Airbnb is thinking about sharing are giving their shares to the hosts now. And they're a very centralized company, right? And Justin, maybe if you have the link. And that was a great find, because now Airbnb is understanding that they want people to have vested interest in Airbnb as a host, because they know the hosts are so important. So they're almost trying to do what you can do in crypto naturally from a centralized standpoint, and seeing the value in that, which is great. So yeah. So, and I think, Justin, I agree with you. I think this is giving people opportunity early on for equity, and having, and as Jake says, as many wives as you can agree to the arrangement, or who would agree to the arrangement, or get, anyway. So like, yeah, it just, it gives us a whole lot more opportunity. Right. So, yeah, I think that's the beauty of this system, that it allows you to create so many more organizations that everyone can participate in as early stage as possible. Typically companies, and I do see, like, as a startup, you have these founder shares, and it's like very lucrative, but you eventually have to figure out a way to distribute it in a way to incentivize everyone to grow the pie and grow the company. And oftentimes I think it is too concentrated, and people And as startup founders, you try to do too much early on without kind of spreading it out and getting a lot more people involved. So I think this technology will allow that to be more efficient. And I think that's a great thing. It's more sustainable too, because if you do have concentrated risk among a few people, if something happens for whatever reason, you don't have a contingency or continuity plan, right? And as you get more people involved that are involved, they can kind of take over for whatever reason. And there has to be a method to do that too. Maybe, you have a way of selling all your shares to the open public. Oh, Jake left. But it's stuff like that where like this is what happens in founding teams a lot. Like there's like 2 or 3 founders. It's just bootstrapped together. There's a kind of a ugly kind of conflict, and then one person leaves, and then so you have like people like, let's just say 33. One person like says, I'm not going to do anything. I quit. So there's 33% stuck. And then the other people have just 66%, and they're doing all the work, but they're not incentivized now because 33% is stuck doing nothing, right?
Mm-hmm. Creates an awkward sort of situation.
It's like, okay, so we're doing all this work and this guy's going to benefit with 33% or whatever. Yeah. So there's issues where you have to kind of unwind people who are not actively involved. I mean, that's just one scenario where concentration and being able to have like a continuity plan if certain things like that happen, that would make things much more effective if you have resolution, because that's one of the biggest things in startups that, I mean, it's all about kind of keeping teams together. And a lot of it is just not even the business. It's just teams not like working out.
It goes, a good example of that is actually with Facebook, and, Eduardo Saverin had a sort of a bit of a falling out, and then he sort of wasn't as involved in Facebook. And their solution to that exact problem, where perhaps they felt he wasn't contributing anymore, was they diluted the fuck out of him. Basically, like they diluted him down to almost nothing.
Yeah.
And it'd be good to have a more controlled and pre-agreed to method of dilution, because that's basically what it is if you inflate the system, and perhaps people who aren't contributing are no longer gaining from that inflation anymore. And that's the way you dilute them out. But if you have an agreed rate of dilution or more control and governance around that, you avoid that situation where someone is shocked that they've been diluted all the way down from 25% or whatever it was to 0.001%.
Yeah, that's a great way to
explain it. And no one else is
that's
diluted.
A great way. That's exactly what it is. It's the concept that you're just really inflating away with future contributors. But that's an extreme example, and I think Peter Thiel in the real life was kind of the person who suggested this method where if you do have majority stake, you can actually do that. That's the kind of the flip side, where there can be some maybe some issues that allow majority stakeholders to dilute away minority stakeholders, which, like you say, should be balanced. And maybe Eduardo, despite his kind of breakup, should not have been as kind of severely affected as he was, but he still did well. He's like, I think he won the lawsuit, and he won like a significant lawsuit, and he's doing well. So I mean, but yeah, those are the issues that I think in the blockchain world, those are really the edge cases that we can solve automatically. With blockchain, just make it algorithmic as a smart contract with things like these all predetermined, so that
I mean, I don't know if they're edge cases though. Like, I mean, it is an edge case to have such an extreme dilution, but to get into that situation is so common. Like what often happens, I feel, is that person who had the 25% or 30%, I don't know, you either need to buy them out, but often like people just get unsatisfied with the fact that someone has such a high stake yet is not doing any work, and then the company just implodes because people feel how unfair it is. You know, that person's not involved and they're still holding such a huge, so it just hits morale really, really hard, and it ends up hurting the organization itself.
Yeah.
And that's, I feel, really common.
Yeah, no, I agree with that. So there is a balance that you have between those two, and it's a common issue. I was just thinking the maybe the edge case was more so the extremes of what happened at Facebook. And so funny is Shaheen had to go. He's a physician, so he's got patience. Yeah, Jake, he's had to eat. So if you want to kind of join us, anybody else, let us know. But yeah, I do agree. These are all great kind of just things to think about, I think. So that was good about Airbnb that you linked up kind of last time. Incentivization. I mean, let's talk about one topic. Maybe let's stick with EVA, maybe, just because you kind of started with that earlier in the broadcast. So maybe what do you think? Talk about the tokenomics of EVA. Just maybe we should ask Jake what the
I want Jake to come back so we can actually get him to give more of a detailed view of how it actually works. Because I feel like I gave a very simplified method. I do know that there's also like a 15% fee with EVA, which sounds it's lower than what is normally the case. But I wonder why they needed to have that fee and why they can't make it zero. I don't know, and pay. Obviously, you need to pay arbitrators and, you know, people to code and that sort of thing. But I wonder if they could have done that with inflation instead.
Yeah. What is the fee? So the fee is so it's always interesting. So like, you know, you have a typical pie chart. You have, you know, the team founders maybe getting 10 to 20%. Then you have and advisors, so team, you know, the founding team and advisors maybe 10 to 20%, and then you distribute a certain amount for a variety of different operational expenses, and then maybe partly for marketing and whatever it is. You know, the pie is split in different ways. It'd be good to see what.
Yeah. It says, drivers keep 85% of the fee, get 85% of each ride.
Okay, so
it just doesn't make sense to me. It seems to be replicating too closely how things work now. I don't know what the Uber fee is, but I don't know. I would think maybe 20%. Maybe it's much, much higher, and this is actually a huge improvement.
So Justin says Uber is 30%, and it looks like half. And then he does have a PDF that maybe I could share. Just
that would be great.
So let me see this. So if you look at this, you guys can see it, right? So on the right-hand side, we have rider members, driver members. Driver members get 85%. And then 10% go to this cooperative. 1% goes to this foundation. 4% goes to the ecosystem treasury. The cooperative and this EVA ecosystem is variable, it says. So this is the current setup, and
looks like the holders get some of that ecosystem treasury. So it is actually kind of like a security where you actually earn interest on your money. or a return, I guess.
Yeah, that is true. So, so drivers get 85%. So holders are get essentially, 4 of the 15%.
Yeah.
Foundation is the company. So company gets a little bit cooperative. I'm wondering what the cooperative is. So maybe local cooperatives for legal, security, and marketing matters. So it's probably just another organizational like entity that does marketing. Just has,
worker proposals. It could be those things in the form of a worker proposal type system.
And it makes sense because, I mean, this is a nice description. It's very simple, and you could learn a lot from just this graphic here. And it's a cooperative. So and I think it's local cooperative. So every every country has different regulation, right? And so that makes sense. From white paper. Thanks, Justin. Justin's always like some good quotes and excerpts here. A cooperative is a corporate body of people that have common economic, social, or cultural needs, and who, to satisfy these, join forces to operate a business following the rules of cooperative action. Page 14 of the white paper. So so this is like another organization, a cooperative rather than a company, but also is appropriate because you just have a local regulation that you have to deal with. You have consumers that are local, and it makes sense to have this structure as a way of expanding in a particular region. So makes sense.
Definitely.
So
yeah, it's interesting. I mean, we're going to see so many different decentralized Ubers or decentralized ride shares, and they're all going to do it totally different, I think. Like, there's just going to be so much variance in how they work until someone strikes the right model. I mean, this could be it. I just don't know.
Yeah. It could be. I like the model. It's very simple. It's just like what makes a company successful, right? So it's like I think the economics have to be aligned in this space, and it seems to be pretty good. And there's another one in India that also was with EOS Ignite. They're called Drive, and so they're also a ride sharing app. So we'll see. I mean, this is just one of those. So let me see. So this cooperative model, how does that compare with just a regular company now? So you have 85% going to drivers. You have like a 4% dividend for investors. And then the rest is to
many of those who are drivers, which is good because the drivers might not necessarily sell all their tokens. So the drivers will be getting that security return, which is good. True.
So the drivers are incentivized to be part of this, the growth of the company, or this ecosystem. And you have these cooperatives that are also, so this project lets non-accredited investors get in on stage one. That is the real power I see in this. So Justin says, yeah, so non-accredited investors, if you did go the securities route, there are regulations that allow non-accredited investors to invest in the US, but it's not really that popular. But it is a natural benefit to allow non-accredited. This is in Europe. This is in France, right, Justin?
Yeah, it is.
So yeah, there's different regulations like in Europe, and there's like Europeans don't have to really worry about the accredited investor. You don't have to be a millionaire to invest in Europe.
Yeah. So, what do you think of the whole accredited investor thing? Is it protecting people from bad investments, or is it just a way to keep the rich rich and the poor poor? You know what I mean?
Yeah. So Justin says it's a sham. I mean, I think effectively it's a sham, but I don't think it's intentional. I think it's really the realities of what happens when you have an open system, which I am concerned with. When you have an open system of investment, there is a lot of fraud. I mean, we see a lot of the ICOs, right? So with opportunity.
But do people get smarter over time because of that? Like, I mean, you let it more open. Like when people get burnt, they're not going to go keep putting their hand on the fire again, are they?
Yeah.
So that's an interesting argument. I don't know the answer.
Yeah. No, I agree with that. I think ultimately that's the best way, where people have to learn to be responsible, and that we can only help so much. But I think, so I agree. Ultimately, that's the best solution. But the reasons why they exist is more of a reaction. When people get upset, they feel like they did get defrauded, and people complain. And when they complain, they'll fight for regulatory scrutiny. So it's hard. I mean, it's just really a lot of this stuff is reactionary, not really like some conspiratorial plan to keep the little guys down.
I mean, who knows? Like, unless you research the history about how it came about, it's like it could be a mix of both.
It could be. I mean, I'm open to that. I just think though, because the reason why I'm also like I'm willing to go out and just be all like in the Wild West, right? And because I've thought a lot about going outside the system, right? But I am concerned about like what that means, because there will be fraud and scams that happen, and there will be consumers that there is this potential liability that from consumers. So I feel like you need to account for that, right? Mm-hmm. And if you're going to the Wild West and building a business and having this regulatory arbitrage, that you have to account for the other part, even as just a part of the strategy. You have to minimize. You have to put either bonds up. You have to have some vetting organizations that are built, self-regulatory organizations. You have to do all that stuff like at the same time. It's not like you could just go and just create all this stuff like without the regulation, which I'm fine with, is better as a business, but there's just this natural, when you're dealing with value, and that's why securities law is, I think, there doesn't make sense. Like, it's so easy for people to take people's money and then run, right? It's too easy. When you're in a business, it's too easy to do that. So it's like, all right, so you do like, and that's been probably since the beginning of business, like that has happened. And so I think there's extra care that is required to make sure that's minimized, reputation, building kind of self-regulatory vetting institutions, things like that are just going to be very important if we go in the realm of like, hey, we're just going outside the like any regulatory kind of framework. So, and I think that saves us, like, because SEC is only going to enforce when things go bad. They're just they don't have resources, so they'll only go for the outright scams, really, right? And, anyway, so if we minimize that, we're in good shape. Even if it's illegal or whatever, like they won't go after you. Is my thought. So
interesting. You look at 2017, like people were just throwing money at anything. Like, you've got an idea and a white paper and you got a few guys on your website, I'll throw like $1,000 your way. Like, but 2018, you've noticed like people have really gotten smarter, that people like with legitimate ideas and legitimate prototypes are struggling to get money now. So people have smarted up quite substantially, I feel.
Yeah.
So like, I mean, that was chaotic in 2017, but people have learned their lesson from it. Like, people aren't throwing money around anymore.
Yeah, that's true too. I mean, I think that's you learn a lot, and that's a very powerful educational tool, just experience losing money. And I tell you, even after me, like I've went through the .com. I'm old enough to have experienced the .com in the 2000s, and I lost a lot of money then. And you think you learn, and I have learned over time, but I still am. I have bad habits sometimes, and like you don't vet companies are hard to vet sometimes. Like you think they have honest intentions, but unless like you really dig in, you don't know. And so diversification is always important, and sometimes I'm concentrating on things where there could possibly be bad actors, and that takes a lot of experience, like many years, so that I feel like, yeah, you can learn maybe even after the experience in 2000, I still like should be even more careful, right? Today. And it's I'm not like, and so I know partly it's my fault. So I take responsibility there, but then it's also difficult. It's like some businesses are just hard to vet. So blockchains help that because everything's more transparent. So like you can't cook the books like I would say most organizations today cook their books.
That's true.
So you can't do that with blockchain companies. You got this natural transparency. Hopefully everyone's public about like, all their activities. And everything's more spread out so that there's, less potential for one bad actor to kind of ruin the whole organization. So things like that, I think is promising. So,
and you're right. I think to some extent you do need protections because, I mean, you could use diversification to hedge your risk across multiple bets. But the fact is, if you diversify too much, you can only do so much research on each. Like, if you're only going to throw in like $500 on each, then, realistically, how much research time can you put in that to have it worthwhile? So you're going to get scammed if you don't research properly. So
yeah,
you can only diversify so much, right?
There's the economics behind investments too. Yeah, like research takes time and money. So you may have to do a few $100s of research to invest $500. It's not like efficient, right?
Yeah,
and so that's a good point. I mean, I didn't even think of it that way, but that's true. Like there is monetary value that you spend in study, research, all for every company. So diversification is there's a cost to that. So but I would say like that's what I was probably like. So sometimes like concentrations, like you think a company but it's like you almost have to have the inside information about a company to really know like the reality of a traditional company. Hopefully this blockchain will just help, just help minimize all of that. So Hive Mind is what Justin talks about. Hive Mind and radical transparency, open source, reputation weighted voting on projects. So Hive Mind, is that the one? Is that the Bitcoin one? Hive Mind. I know Paul Stork, who's kind of really well-respected kind of technologist. Let me see. Do you have a link to the Hive Mind, Justin? The Hive Mind. Oh, the Hive Mind is just this idea of having kind of everything crowdsourced or and having radical transparency, open source, reputation weighted voting, things like that. So you can solve the issue of scams. So yeah, I think this decentralized nature allows for people to identify these things a lot better, like just the collusion and stuff with people are paying attention. So with block producers and things like that. So there is a community crowdsourced kind of effort to help minimize this, which I think we can rely on as well. So
yeah, definitely. And say if there is like an ICO, you could use code to kind of lock up that money that comes in to protect investors. Like you can put certain protections around the money to stop people from just running off.
Yeah, and this is another important point about ICOs in general. And I think there was at least not too long ago a trend towards having vesting schedules like what you would normally have in traditional startup companies. So founders would have a vesting period. Usually for startups, it would be 4 years. There might be a cliff. There might not be, but essentially a cliff is you have to work for a particular amount before you get anything, like let's say a year. And then you get, monthly, you get, equity that's split up over 4 years after that. So that's a traditional one, 4 years with or without a cliff of vesting of all your shares that you gain as a founder. And I think things like that are good. It incentivizes people. And I think tokens that have vesting schedules make more sense, especially if you're trying to create something more like a company. So one last question. So what are the pros and cons of doing this utility token side, let's say, and getting a lot more people involved? Like how does EVA compare to a traditional company? And let's say you did this traditional company purely on the blockchain, get some of the benefits. Now let's have them compete. So let's say I do EVA company or EVA 2, and just make it more like a company, and then this just compare it to EVA, where there's this a little bit more of a cooperative structure. On one side, you have tokens, drivers getting 85%. So let's say EVA 2 company says 15% goes to the company instead of say this cooperative foundation token holders. It just it goes straight to the company and company shareholders. So 50% all shareholders, maybe the founders get a higher concentration. Let's just say, just like a bunch of 3 hardcore founders, and it's just big company. So replace this diagram that we have here. Let's maybe just analyze what you think are the advantages of this versus just what a traditional company would look like. Aside from all the other benefits we mentioned about blockchain, because we were assuming they're both blockchains, companies or organizations.
That's an excellent point. I think one of the advantages has to be that you're getting paid in this utility token that is hedged on demand increasing, for you to actually obtain more value. They only lock you in for 1 week with that token before you can actually turn it into fiat. But in theory, I think a lot of people will only withdraw or change into a stable token. They'll only do a portion of their pay, maybe 80%, maybe 50%. I think it'll encourage people to easily become holders of the system and therefore entwined with the success of the entire system. So I think that's probably the biggest positive. Whether
okay, go ahead.
Company or organization can grow faster than an Uber, I'm not sure exactly how the cooperative works, whether there's enough incentivization there. Also, the fact that drivers only get 85%, it doesn't sound super enticing, maybe compared to what the 30% you get on the centralized version. It is enticing, but that probably is enough, actually. That is a pretty good increase in your profitability, so that is a positive. But yeah, I think there's a lot of incentives on this system, but I don't know. The UX has to be as good as the centralized version. for it to succeed. And there's already these huge incumbents in terms of Lyft and Uber that they have to compete with. But yeah, I don't know. What are your thoughts, Julian?
Yeah. So okay. So for the first point, I do agree the incentive mechanism, especially for the drivers who don't take their pay in just cash, will have greater potential to be faithful and loyal to this system. However, I think if you create a company kind of structure, you can also make it so that they can either be paid in stable tokens or equity, and having them choose the percentage however they want and convert as however they want. So that part, I think you can recreate the same way, is what I would say. So maybe you can still do it the traditional way. Maybe also like the cooperative is kind of like a company when you think about it. It's just a different structure. Like, so maybe the 10% is just like a company, or the 14% is kind of like a company you can think of, right? Mm-hmm. You have a treasury, which is like the dividends. You're just issuing dividends from the company from the get-go. And the cooperative is just another, you can have a corporation or a cooperative. It's just, those are maybe something you can compare kind of outside, like just, what's more effective, a cooperative or a company? And people can argue both ways, I guess. But aside from that, maybe if you replace the cooperative with a business, or the ecosystem treasury and the cooperative, the 14% as a business, and the 1% just goes to the foundation, that's fine. You could kind of recreate the same thing, except you're issuing 4% dividends. That's just like embedded. Mm-hmm. And okay, this is from a business standpoint, I'll just mention this about the dividends. If you're a growth company, you don't want to issue dividends, right? You want to use all the working capital, all the proceeds that you receive into the growth. So you actually want to make no profit, use everything in the growth phase to grow your company. And only when you're stable should you have a dividend come out as a general rule or general practice. So most growth companies don't have any dividends or issue dividends. They're in growth phase, so everything that they earn, they should be able to use have a better ROI on their revenue or their profit to grow mm-hmm. the company. So that's just a business like rule of thumb, I think. So
no, that's an excellent point, and that's a significant disadvantage of this EVA model, because if it was a traditional gig economy company like Uber or Airbnb, they'll take investment and they'll spend like way more than they're actually profiting on actually expanding the reach of the company. So like with this model from the get-go, you're giving holders 4%. You're just not going to have as much money to create a marketing campaign and, spread this organization or co-op like across the world really quickly. So it depends on what their token distribution model is like. I don't know if they have a page on that, but if most of the tokens go to the people who buy into the ICO, they're going to be at a significant disadvantage, I feel. But if they're actually giving bonus tokens to drivers, especially in the beginning phases, maybe it will create that incentivization. Or maybe just as this increases its reach, because people see the token price going up so significantly, it will just create a viral effect. That could be a huge possibility. A lot of people have talked about doing like a rideshare on a decentralized platform, but no one's actually executed on it. So we actually haven't even seen whether it can work or not. So
yeah. No, and you make some good points, and I think, this is actually a pretty close structure to like kind of this equity model, except that they don't split like the equity and the utility side. So it's just, that's fine though. I think that's okay. I think overall, yeah, I mean, it does seem pretty reasonable. Like the structure, it's to me more like a company structure when you actually drill into it. If you look at the valuations too, like if you see the initial token issuance, they have an initial valuation that's what you do in a traditional startup. Like they valued it like at 500,000, which is reasonable. So they issued, if you look at it, they issued it at 25 cents, 2 million tokens, and the valuation is 500,000, right? So that makes sense. You're 25 cents, 2 million equals 500,000, and that's that's the initial token amount. And then they have these other valuations. They go quickly to 11 million valuation in the first quarter of 2019. So you kind of automatically have this huge kind of bump up to valuations. It's kind of interesting.
They're not going to release for a while, like until 2020, right?
Yeah, so they do have kind of this release schedule, and I think that's okay. One other alternative is to release it at the market. This is kind of interesting. That's like kind of the airdrop model, where the valuation is just determined every day by the market. And the EOS ICO was kind of like that, where you're issuing it and the market's determining the price, and that's kind of really the valuation at any given day of your ecosystem. And so I think that's another alternative. This one is a little bit more like, okay, they're going to just have these set valuations, and that will that's what most companies do, because it's a private market. There's no liquidity for, but I think one interesting thing with blockchains are that you get instant liquidity. So you can have a valuation almost daily, and you can just use that as the valuation of every token that's issued on any given day. And you don't have to really, you can always start with it, but then ultimately the market's going to determine your market value. It's a little tricky if it's not that liquid. You might have some weird pricing, but other than that, if you do have liquid markets, it's probably a better indicator of market value than just maybe an internal kind of valuation like study that says, okay, my company's worth, I think, $10 million, next quarter, or in 2019. So anyways, that's a kind of interesting. I think it's fine. I mean, they're doing kind of using the traditional kind of cap model progression.
Definitely.
And
that's where it'll be interesting whether these companies or blockchain initiatives that use that more traditional model, how they go versus more of a community model where they encourage just open contributions, and they have a slicing pie model like Telos did, and see which one, when you put them up against each other, which one succeeds more. Because I think when you have this more traditional model where you have like staged investment, you become sort of the stopgap for progress, because you need to do all the hiring. You need to go through all those traditional processes to get people on board. I assume maybe you have to pay people in fiat. I don't know. There's all these rules and regulations and contracts that you need to be involved in. I just want to see, like, how do those initiatives go compared to the ones that are more community and openly orientated?
That would be a great experiment to see, and you probably need a handful of examples to compare, like at least maybe 10 companies doing both approaches. And I do think the community model has a lot of advantages, and then it's more, to me, more the centralization versus decentralization aspect. Just finding, to me, that there should be a kind of a sweet spot, I think, between the two, where if you can define the right goals and metrics and measure contributions, at least relatively efficiently, I think that will be great. I mean, so I think that's the goal for the DACs, to identify metrics, goals, and how, like, different ways of milestones and compensation, just to try to figure out where that is, because there's just random thoughts that I also think about, where sometimes it's like recruiting people to help as well as, like, human resources, right? So you want to incentivize people who identify talent that can contribute on a particular task, and you want to compensate people to recruit too, right? So there's human resources allocation piece in an organization, on top of, like, oh, I just need this task. Maybe there's just some specific code that you need a rockstar developer to create, and you need to identify, like, through some kind of referral mechanism, this rockstar, you need to identify them and have them work on it, or convinced to work on it. And so just compensate, like, human resource kind of help. And so yeah, even that. So you have human, I think you almost have to add a human resources, like a decentralized human resource component, where like, I think there's specialized talent, which is what's missing when you crowdsource, because everyone's having to relearn maybe things that they don't have experience in, which is okay, I think, but we want to keep it open for that. But there's our specialized, like, activities that you want to compensate and reward at a premium, like these activities. Like, if they have, like, they know somebody that's like for a business partnership, like exchanges, like I think Telos is one. It's like, these network, and you can find someone who can really build business partnerships. You need to compensate those people.
Yeah, and how do you compensate that at the fair rate? Like, not definitely like the hourly rate. Like, if they get someone big on board, it's worth so much potentially.
Yeah, and I think people are like, if you're kind of more on the hourly mindset, and you're doing more of the kind of the day-to-day work, sometimes you undervalue, like, sometimes, I mean, it's like, what? Sometimes it's worth hundreds of thousands, right? Like, for an exchange, because you get so much liquidity, it's like worth probably 100,000 to do something like that, right? And so it's kind of hard, because you kind of, if you're doing the day-to-day and you're getting paid, like, whatever, a few hundred or 100, whatever, like, and like, oh, you see 100,000 is like, but it is, in terms of value, I think if people recognize that, it makes sense. So, but being able to do it in such a way that people are agreeing to that and understanding the value is there's always going to be a little bit of back and forth in, but I would compensate like exchange people who can get people on exchanges, like a lot, So Jaron, you say can you reference a case study that validates that statement? I guess, which statement? Peer pressure represents a type of simple feedback loop with significant effect. So, okay, so I think Justin wrote something about EVA, and maybe we should read this. This is kind of an organizational thing. So, Justin, do you want to, or we could both read it silently, or just for the audience, maybe we can just read it out loud too.
Yeah, sure, go ahead.
Do you want to do it? I've been talking too much.
That's all right. Is this the horizontal forms? Is it that bit?
Yeah.
There are no mechanisms through which one contributor can control another one. Peer production processes are structured with the help of formal systems of roles or accountabilities and reputation through voluntary subordination. Peer pressure represents a type of simple feedback loop of significant effect. Within the governance body, there is no vertical hierarchical structure. Interesting.
And then I think Geron says, can you reference a case study that validates that statement? Yeah, I haven't heard specifically about this concept about peer pressure, but holacracy is Zappos is what oh man, what's his name? Shea, Tony Shea, is it? But he's the CEO of Zappos, and he uses the concept of holacracy, which is more of a flatter organizational structure. So there are benefits to that. There are downsides as well, but I think at least as an example, they have done at least a relatively, I guess, good job of implementing. It's not perfect. I know there was massive kind of restructuring, but it is a flatter organization. There are, I don't know how they structure. There's like circles and there's probably leaders, not leaders, but it's a flatter organizational structure, empowers people on the edges to be able to create and create new projects and things. So I think it's something to look at. I think it has benefits. It also has some downsides. So where is the hierarchy? Where is the value in the hierarchy? So maybe we should attack it on the opposite way. Where is the value if there is a hierarchy, right? Command control, like we're trying to. I mean, it seems we're trying to get away from that in this crypto world, but are there, if there's efficiencies as well? So what is where can we benefit the most in flattening it out, and what are probably things that are more effectively done centralized would be interesting. So what are your thoughts, Justin, about that, or anybody?
Yeah, these are all kind of new topics that we really need to explore by doing.
Okay.
But I think there could be a global reputation system that actually causes some of that peer pressure. Once we have things like identity, I don't know, maybe people can get reviewed for how honest and how good they were to work with, and that will help people fall into line in terms of working in these communities.
Okay.
But yeah, I don't know. It's very new. We should just let chaos unleash and see what happens, because we just need to learn,
I totally agree with that. I kind of like taking like a dual approach. I like take your best guess or best hypothesis based on everything you know, and then experiment like heck, right? So take two approaches. It's better to have some direction though in the beginning, or some vision, and then just iterate based off that. Maybe just kind of occasionally just kind of do some random things and just forget the too much thought. But I think having some sort of direction is also helpful. Mitigate risk by numbers, no brainer. So yeah, just the decentralization helps just by spreading kind of concentration of risk, I think, as well. So just by numbers, you have a lot more people involved, a lot more people just incentivized. So. Mm-hmm. All right, so cool. I think we're already 30 minutes over, so we should wrap it up. We'll try to do this weekly. What are topics you want to discuss kind of in the upcoming weeks, or any last words you want to say, Justin?
We could look at a different DApp every week, or a different DAC even. I thought it was great actually today, going over EVA and analyzing that and getting everyone's opinions. I think that worked really well. But it'd be great to get actually the founders on the show at some point and get their perspective as well. Yeah,
that's actually good. Just we're kind of making all these assumptions. about things. But we had good data. Like Justin has provided us a lot of good links with the white paper and stuff. But yeah, we should just get the founders, and then really just try to dive in deep about like the tokenomics and the models behind everything that's going on. Jerron, thanks for that. He says it's his favorite weekly show, so thanks for doing that. So I'd love to hear a review of BCAP, which is I think it's Blockchain Capital. Is that the venture capital fund? And so EOS DAC is another one. So yeah, BCAP we should really discuss. They have a new venture capital model. It's more of a security token model. So, but it is very, I think, very useful to understand how they did it.
Definitely.
Lumios, Tribe, Boyd, Nebula, more EOS DAC. So yeah, all of these, we should just dig into the tokenomics.
Definitely.
So maybe we'll recruit the next company to join us in our next call. And then, that's a good way to just dive into like actual tokenomics of existing companies. So,
yeah.
All right, sounds good. Anything else, Justin?
No, that was great. I really enjoyed it, and I'm looking forward to the next few weeks.
Yeah, thanks for the suggestion for Eva. I thought that was that's great that we were able to learn a lot about like this system, and I think they've done a good job, overall. So it's probably one of the at least kind of better models that I've seen. So
definitely.
All right, guys. See you next week. Really appreciate it, and I hope you have a great week. And we'll see you guys soon. So
thanks, June. Cheers, everyone.
All right.
Appreciate it.
Take care.
Ciao.